Today, we are diving deep into Maruti Suzuki's latest quarterly results. And honestly, it's a fascinating story. On the surface, you've got this incredible success. We're talking record sales, a market that's just roaring back to life. But when you look beneath the hood, there's this really interesting tension between those booming sales and profits that are getting squeezed. So let's break down what's really going on.
What we're looking at here is a classic business case study playing out in real time. Maruti Suzuki just had an absolutely massive quarter, but believe me, it was not all smooth sailing. They were up against some pretty significant headwinds, and that forced them into a strategic pivot that is all about getting ready for the future. So let's unpack exactly how they're navigating all these challenges.
All right, here's our roadmap for today. First, we'll hit those phenomenal sales numbers. Then we'll get into the nitty-gritty of why the profits got squeezed. After that, we'll check out their super aggressive expansion plans, their big push into EVs, and finally, we'll size up the risks and opportunities that are waiting for them down the road.
So let's set the scene, shall we? The entire Indian passenger vehicle market just had an absolute blockbuster quarter. And a huge reason for that was one major event: the government's historic GST reform. Now, this wasn't just some minor tweak. It was like a powerful shot in the arm that supercharged demand across the entire industry. And you can see the impact right away. A 22% jump in domestic sales volume for Maruti. I mean, that is a huge turnaround, especially when you consider that in the first half of the year, they actually saw a decline of almost 6%. That GST cut basically lit a fire under the market, and Maruti was in the perfect spot to cash in. And don't just take my word for it. The company's own chief investor relations officer, Rahul Bharti, pointed this out, saying the whole industry surged by over 20%. So this wasn't just a little bit of growth, it was a massive shift from a market that was actually shrinking to a full-blown boom. And it happened almost overnight. You know, this quarter really pushed the company to its absolute limits. We are talking about their highest ever sales, both in the number of cars sold and in total revenue. Their order book was enormous. They had almost no cars just sitting around in inventory, and they were even running the production lines on Sundays and holidays just to try and keep up. This is what red-hot demand looks like.
Okay, so if sales are at an all-time high, profits should be too, right? Well, this is where the story starts to get a little more complicated, because behind those incredible headline numbers, a very different picture starts to emerge.
And here it is. This is the central puzzle of the quarter. Despite that absolutely incredible sales performance, their operating margins, basically how much profit they make on each sale, actually got smaller. It dropped from 8.4% down to 8.1%. So the big question is, where did the money go? Let's dig in.
So this chart breaks it all down for us. On the positive side, selling way more cars gave them a huge 1.9% margin boost. That's from something called operating leverage, which is just a fancy way of saying they spread their fixed costs over more cars. They also offered fewer discounts, which helped another 1.2%. But then came the headwinds. The single biggest hit was a one-time charge for a new labor code, which cost them 1.25%. And after that, it was like a story of 1,000 cuts. Little things like price reductions, rising material costs, and other supply chain issues all just chipped away at their profit.
Now, that single biggest negative factor was this provision of nearly 6 billion rupees for a new labor code. But the really key takeaway here, and this is important, is that management has said this is a one-off cost. It's related to past services. And that's critical because it means this shouldn't be a recurring problem that drags down their profits in the future.
Beyond that one-time hit, though, the ongoing costs of raw materials were a huge issue. Prices for precious metals like platinum and rhodium, which are absolutely critical for emissions control systems in modern cars, were all over the place. And on top of that, there was a supply chain breakdown for rare earth elements that created this really weird and expensive problem. Get this, instead of just buying the small magnets they needed, they had to import and sometimes even air freight entire, much more expensive sub-assemblies just to get those little parts.
Now, with all these cost pressures, you might think Maruti would want to hit the brakes, maybe slow down a bit. But no, they're doing the exact opposite. They are doubling down. The management team clearly sees this demand boom as a long-term trend, and they are investing aggressively to get ready for it. And the pace of this expansion is just incredible. They have 2 brand new production lines, each capable of building 250,000 vehicles a year, coming online just months apart in 2026. And they aren't stopping there. They've already announced another brand new factory in Gujarat. This is about as clear a signal as you can get that they are building for a much, much bigger future. And this kind of expansion isn't cheap. The company is spending at a rate of about 10,000 crore rupees per year on these projects. That is a massive investment, and it signals just how much confidence they have that the Indian growth story and their place in it is really just getting started.
So they're building all these new factories for today's cars, but what about tomorrow's? Well, that brings us to their long-term strategy, which is really focused on two key things: electric vehicles and expanding their global footprint. Before we even get to EVs, it's really important to understand just how dominant Maruti already is when it comes to exports. If you look at the data from calendar year 25, they accounted for nearly half of all passenger cars exported from India. This established global network, which reaches over 100 countries, gives them a massive head start as they start to roll out their EV exports.
And to support the big EV push here at home, they're tackling what is probably the biggest hurdle for people wanting to buy an electric car: the charging infrastructure. They're using their huge network and partnering up with charge point operators. And their goal is incredibly ambitious: to enable a network of over 100,000 charging points by 2030. They're not just selling cars, they're trying to build the entire ecosystem.
Okay, so we've seen the really strong present and the ambitious plans for the future. But no analysis is complete without taking a clear-eyed look at the challenges and opportunities that are still ahead. The road ahead is really all about balancing these opportunities with some very real risks. On one hand, the big question is whether this crazy demand is actually sustainable. The early signs look pretty promising. There was a 7% jump in first-time car buyers, which suggests this might be more than just a temporary blip. But on the other hand, the risks are very real too. Volatile commodity prices, geopolitical trade issues, and just how hard it is to protect against sudden cost spikes, all of that could put a serious dent in their future profits. And that really brings us to the final question. Maruti Suzuki is clearly in the driver's seat of India's auto boom. They are investing heavily in new factories and future tech. But the road ahead is absolutely filled with these cost pressures. So the ultimate test will be whether they can